All right, so we are going to review gold and then compare it to Bitcoin. So we go all the way back now to our small family tribes, and they used IOUs, and then these IOUs were gradually replaced by tangible items. You know, salt, wheat, cattle, etc. These became tangible tools that helped increase cooperation. These were the first mediums of exchange, and then when we arrived at precious metals, because they gave us the higher value density that was needed as we entered into the Bronze Age and we had more advanced production and trade and just cooperation in general. And just like the salt and the wheat markets, the precious metal market, they were their own free market good. And when it came to gold, it was the best at holding its value because it remained the most stable. We're going to look a lot at why. This is our stock to flow chart. We see gold's the highest, and gold is the highest because you had this existing stockpile. This is the above ground gold that we have access to. You know, gold is indestructible. It's not going to have some chemical reaction and go away. It's not going to be consumed in some fashion. At the atomic level, gold is virtually indestructible. And all the gold we've ever mined in history is still around. It's still above ground. We still have it. So even if miners put in a heroic effort, you're not going to put much of a dent in this overall pile just because there's so much of it. Whereas if you look at the other items, salt and wheat, you could lose salt, wheat gets burned, you eat it, you consume it. This pile can go down very quickly with many different ways. And then other items, it's very easy to obtain them, to increase the flow. You can go set up a huge wheat field with no barriers to doing that, and you can increase the flow in a very easy fashion. So what the high stock to flow means is that on the supply side here of our equation, this line is very difficult to shift to the left or to the right. Gold is an example. So we'll say that the demand for gold goes up. So we had this demand curve. It's going to shift to the right. So what this is saying, and there's a higher quantity of gold now that's being demanded, or more people who are going to want gold now at this value, at this price. Then we have the suppliers now, they can't meet this new demand. So what happens is the demand is going to get pushed back up this curve a little bit. Suppliers are incentivized now to start trying to increase the quantity. We're going to find a new equilibrium at some point in this space. There's going to be a new equilibrium that's found. And you know, gold's going to fluctuate in value as this happens, as the supply shuffles, the demand shuffles. But all these shuffles are relatively small. Whereas if you look at the other precious metals, they fail what's called this value trap. So we're going to walk through this using silver. So here we had the demand that goes up. Here's the curve, demand curve. It gets pushed to the right. Here's the new curve. And then initially this is going to push the price up. So now we've got this little area right now. And you can look at this as potential profit. So if you're a producer or a supplier, if you can bring more silver into this marketplace, you can now make a good amount of money. So this incentivizes all the producers to go out and bring a bunch of silver into this market. And what happens is just a market flood of silver. And we've got this supply curve now. It shifts in a quick fashion out to the right. And from a supply demand economic point of view, the value now has fallen enormously. But there's something called price stickiness, and this just has to do with humans, and we're fallible. The price is going to remain high, and people are continue to essentially overpay for this asset, and this is recognize this. It's called a bubble, but eventually this bubble is going to pop. The value of this overproduced good will plummet down to where it needs to be, but all the individuals have now lost all their wealth as they ride that down. So that's the value trap. And gold with its high stock to flow means that it's very hard to increase the size of this pile no matter what is going on in this value trap, no matter how juicy the profit might be, it's just hard to make more of this. So the fluctuations or the large drops in value are kept relatively smaller. And you can also think about gold this way. So around the year 1900, the pile of gold that was above ground, you could fill an Olympic-sized swimming pool with it. This is the above the surface gold. That is actually not that much, but it was this amount of gold was the financial foundation of the entire planet. And it's going back to a chart we had a video on about a year ago. This pile of gold here represented all the value in the world. And then a reminder also that it was relatively easy, even for an average person, to verify gold. And it's not just weighing it. You had certain test rocks you could scratch, and they had a depth and a color. You could tell how pure the gold was. So let's compare this now to Bitcoin. And Bitcoin, if you look at it from a stock to flow point of view, we're going to go back to our Bitcoin supply schedule discussion. And the supply of Bitcoin. So by the end of 2012, there were 10.5 million Bitcoin in existence. And then we had the first halving. So every 10 minutes after that, there was every new block that was mined, roughly every 10 minutes, 25 new Bitcoins were given to that. New Bitcoins were issued to the miner. These were new Bitcoins coming into existence. And over 4 years, this is the amount of new Bitcoins. About 5 million came out in this period, and then the halving dropped again to 12.5, 6.25, 3.6 something. Right about now, as of the time of this video, we have almost 20 million Bitcoin that are above ground or in use. And if you look at the stock to flow ratio every 4 years, this is what it works out to. And as you can see, the stock to flow ratio just gets higher and higher, and it's just enormous. And there's also, remember, there's no way to speed up the issue of new Bitcoin. So each node enforces the difficulty adjustment. So every node will look at the average block time, or every 14 days, or 2016 blocks, every node is going to review the time of the last 2 weeks worth of blocks, and then it's going to make an adjustment to make sure we continue to hit the 10-minute average target. And then also, if you look at, both of these remove human fallibility. So gold is controlled by nature, the laws of nature. And then with Bitcoin, it's guaranteed by the code and the Nakamoto consensus. There'll never be more than 21 million. And gold at least minimizes the influence that fallible humans can have. So we have a pile of gold, we have a pile of Bitcoin, and we're going to do a deeper comparison of Bitcoin as money, as a medium of exchange in the next section. This is just focusing on store of value. But they are in place, because at some point when you're storing value over a long period of time, you are going to have to exchange it for a good or a service. So these do come into play. They are still important. And for Bitcoin, you have a transaction that can divide a UTXO, creating more, or you can input a bunch of UTXOs and just get one. So Bitcoin is infinitely divisible, and in addition to that, it transports itself at the speed of light. And a full node or a prune node, which is very easy to do, anyone with a computer can do a prune node, and for a couple $100 you can do a full node, but they can both accomplish a verification of a transaction. So you can accept a Bitcoin transaction with confidence without relying on a third party. And then for the Bitcoin store of value and value trap point of view, and we talked even with gold, you can have these very small shifts to the right with gold, but Bitcoin is never going to have this shift to the right or to the left, whatever. There is no erratic movement on this supply curve with Bitcoin. The supply schedule is completely fixed, and it's enforced by the Nakamoto consensus. And so if you consider now no movement of the supply curve, we have people who demand a Bitcoin, people who are willing to turn over or exchange out their Bitcoin, and you're going to have, certain quantities of these people. What you get is this demand can shift left or right, up and down the curve. The value can increase up or down, and the quantity of suppliers can change around. But the market equilibrium now is determined solely by the buyers and the sellers. There is now no noise or distortion coming from the producers changing the supply. So this is a pure, clean, free market, and the prices now are all a result of these thousands of individuals all making their own individual decisions, all making their own decisions, acting in their best interests. And so with Bitcoin, if you look at the fluctuation, you will have a lot more frequent fluctuations in terms of value, but they're going to be smaller. Whereas with gold and silver, these fluctuations are going to be, on rare occasions, you're going to have these massive wholesale, giant changes in value. And this is what makes Bitcoin just the better, more consistent store of value. But take a look. We're going to take a second now to look at the volatility here with Bitcoin. And this is the price of Bitcoin in US dollars for its first 10 years. And this is not a linear axis here. You can see it's somewhat exponential. And these are massive drawdowns in price. You can see it's highly volatile. But look at it from another point of view, though, from a new technology. From Adam Christensen's book, we know that new technology is incorporated or adopted within these tranches of kind of different flavors. And the store of value market itself, stocks, bonds, art, collectibles, it's an enormous market, and Bitcoin is still a very, very tiny piece of this market as it's trying to attack the market and get more market share. So in this very small market, we have, let's just say, for example, we have one supplier here, and this guy's a multimillionaire. If he is going to exchange out 100 million US dollars worth of Bitcoin, is going to drastically influence the price. And then that's what's been causing all the price volatility, or most of the price volatility in Bitcoin. But as adoption increases, the price changes, the volatility of these changes, they're going to decrease as well, because even these major, very wealthy individuals are going to have a much smaller effect on the overall total. And Bitcoin's path forward, just think back to gold's journey. It took centuries for gold to have achieved the large, worldwide status as worldwide status as a store of value. And when it comes to these properties, it was better at these than the thousands of other things that have been tried. The other precious metals, seashells, glass beads, the buckskins, and so on. They had all been experimenting with it. Gold was the best, and most important, it was the best long-term store of value. So Bitcoin's finite supply, guaranteed by the Nakamoto consensus, is the best mechanism to keep a supply of an above-ground asset from ever expanding. Bitcoin is digital gold, and it is a 1,000 times easier to divide up. There's no melting. And it is 1,000 times easier to transport. You can transport at the speed of light anywhere in the world, any quantity. There's no weight, there's no armed guards. And any person in the world with an internet connection can accept it, can verify it, make sure it's a valid transaction without having to rely or trust in any third party to do so.